A two-day rally. Yes, stocks ending higher for a second straight session in one of the wildest weeks ever on Wall Street. But our next guest says, despite today's gains, he's worried that the extreme volatility we've seen lately may be a sign that we're heading for yet another recession. Chief Investment Officer at Aegis Capital Corporation, Stanley Crouch, joins us now. Stanley, how do you make that determination that this volatility and maybe the uncertainty and the uneasiness among investors is leading us down that path?
Well, you know, when we look at the composite of statistics, the revisions to GDP, quite concerning, particularly going all the way back to 2003. When we look at the debt crises, and I mean that in the plural around the world, there's a lot of things to concern us. There's event risk. But really what it boils down to is a question of confidence. That's been our theme. The confidence level. Who is going to go out and make that purchase, that commitment to a business, to a hiring? Certainly, it seems that the corporate world has not been hoarding cash. You know, we're concerned about that. And where do we go? We really believe we're at a tipping point, and we think confidence will either lead us further astray or to a better path.
But Stanley, history proves time and time again, right here on the floor of this New York Stock Exchange and in the Midwest and in Omaha, Nebraska, where Buffett over and over again would buy on the massive dips in 1987, the 70s, the really difficult times where people were saying, recession, recession, we're completely freaked out. That shows that the performance of equities in the year or two after that were markedly dramatic to the upside, some 15, 20%. Is that one of those times? Some of us don't want to miss that opportunity.
Sure. Well, let's look at, I'd say, some of the fundamentals. First of all, we ended the week down 1.5%. When we think of the swings we've had, I feel like I just got back from the theme park. I almost end up in the same place, but I had a wild ride. And the other thing that's similar to the theme park in these sophisticated days, it's really driven by a computer or a series of computers. So the ride, I think investors shouldn't really confuse with, you know, the end result of being a long-term investor. But I agree wholeheartedly with Mr. Buffett, his strategy. We advocate an income-centric investing model that consists of equities that are dividend payers, fundamentally sound, under-levered, not, you know, high ratios of debt, and we employ that. Now, when we look at the components of the cash flows, we want to make sure that we reinvest those cash flows, and actually decreasing valuations help us in terms of adding more as we go. So while it may be painful to open your statement or go online and see your account value drop, if you're committed to this strategy, both in bonds and in equities, you can use that cash flow to buy cheaper assets as you go. So Mr. Buffett is right up our alley, or we should say more respectfully, we're up his alley.
Well, it's sort of similar to Liz's point about not wanting to miss out. If you got spooked in 2008 and you missed out over the last couple of years, you don't want to do that again. And the other thing, too, is you look at the other asset classes out there. I'm getting nothing in Treasury bonds. Anything that's next to zero in terms of risk, I'm getting nothing for. I'm getting nothing in saving my money. The only way I can make any money is by investing in equities. And to your point, strong equities that pay me a dividend, but I'll take 5%. I'll take 6%. I don't need to get the traditional return that I've gotten historically.
Sure. We work a little differently along the lines of what you're saying. We like to take less risk in the equity portion, and we'll take a little bit more risk in the income portion or the bond portion. Particularly in the muni market, there are thousands very diverse issuers, particularly project finance bonds that are tax-exempt bonds. I wouldn't call them municipal bonds because they're not backed by the taxing power, but they're for solid institutions. Some of them have incredible endowments that are pledged to the bondholders, but you have to do the research. You have to know what you're looking for, and those are great opportunities, too.
Okay, so Stan, let me interrupt here. So you would do something like that, or a Pfizer with a decent dividend or a Verizon with a good dividend over, say, for example, just that 10-year bond. I mean, people were rushing into that thing, and I'm thinking, you're not getting that much of a yield there.
Well, let me tell you why treasuries don't fit the bill for us. It's a question of the fundamentals. We look for strong income statements. We look for very solid balance sheets. The Treasury exhibits deficiencies in both of those things. So from a fundamental credit analysis point of view, we shun treasuries. and they're taxable, and they have the lowest yields, and they're very volatile, as we've seen this week. So that's the other thing. You know, that I talk about a concept, the destitute millionaire. The destitute millionaire is the person who 5 years ago bought a very high-grade laddered CD corporate treasury portfolio. He forgot about one huge risk, the roll-off risk, the reinvestment risk. So his income may have gone from, say, 40, 50,000 with his $1 million of principal. Now he's down to maybe he makes 10, 12,000. He's under the poverty level with that income, and he is, in fact, a destitute millionaire today.
Very outstanding stuff, Stanley. Very interesting. Thank you so much. Stanley Crouch.